Welcome. This is Tax Pro Nation, the home of the independent tax professionals, where you can find a tax community, maximize your earnings, and live life on your own terms. I'm your host, Imelda Ledesma, COO of Pronto Tax School. In this episode, Andy and Andrea will dive into the fascinating realm of advanced Schedule C depreciation strategies. They will discuss the varying treatments of depreciation and explain why capital accounts often don't align between the books and the tax return, attributing these discrepancies to how assets are managed.
Yeah, we're as for anybody that didn't see the email this morning, we are doing like a review recap as a group, as a community next Thursday. So definitely hope to see everybody at that webinar. For this session, we wanted to address kind of like more advanced Schedule C depreciation strategies. Depreciation, something that we often hear from members, even more experienced people, that is kind of tricky. A lot of us don't, necessarily feel really confident with it. So Andrea was going to share some of her thoughts, and then also to kind of keep it going with the participation from the members and your experiences, your point of view in the chat, or even if you want to jump on live. Before we get started on the topic, because I think depreciation can potentially be one of these more academic exercises where we're trying to get into all these concepts and book learning and stuff. So I wanted to see if we could just discuss, like, before we even start the overall strategies piece of this call, is if we're not adept and confident at using these Schedule C depreciation strategies, what kind of bad things can happen, right? And so I just listed out a couple things that I personally experienced. So clients can overpay their taxes in the current year because they may not get as much of a deduction as they could. Clients can overpay their taxes in future years because we often have these choices with these more advanced depreciation methods of which year we want the deduction to go to, so to speak. So I've noticed that if I don't do that optimally, it can lead to a certain sense of regret, you could say. There also is the factor of just becoming like horribly confused. So I think of different things like, anytime I see multiple acronyms in one short area and I don't know what those means, like 100 DBY, ACR, and I don't know what any of that means, it kind of sucks you into that rabbit hole of inefficiency and decreased earning power, and also just a certain degree of psychological misery. And this is something that I was really excited to have Andrea's point of view on too, is so depreciation is often differently treated on, say, QuickBooks, the accounting, versus the tax return. I would say it's like a high percentage of that, right? So That's one of the main reasons we keep having these issues come up, and we've discussed them on other calls of, like, why do the capital accounts never match up, and like why? And so the differing net income, like on the books versus the tax return, a lot of times is attributable to how the assets, the depreciable assets, are being handled. So those are a few of the overall problems that we're kind of trying to help with, and why we feel like, hey, this is going to be a good use of your time to be here today. Overall, Andrea, are those, I don't know if I'd quite call them horror stories, but is it like those things is that a good list of what we're trying to avoid, or anything else that comes to mind?
No, I think that list is great. As tax professionals, even if we're not engaged to do tax planning, we still want to do our best work for our clients, and we want to benefit them as best we can. And so depreciation is one of those areas that can be really tricky. It's very easy to lead clients in the wrong direction. So it's a lot of pressure on us. Clients don't understand. They don't understand what it means. They don't understand the implications. And so it's a lot of pressure on us to give them the right guidance. So I'm really excited for today's topic because it sounds simple, right? Like Schedule C, it sounds like it should be so easy, but there is so much more to the depreciation discussion than just put an asset in the tax software and let the software do whatever the software is going to do.
Yeah, and on the opposite side, obviously, of these things that we're trying to avoid, there's the good things that we can get from really feeling confident with the depreciation strategies, even the more advanced ones. And number one in that category is obviously like tax reduction. And these are things that can hugely reduce people's tax liabilities, which for Schedule C clients is obviously a huge priority for those clients. So that's why Andrea and I were excited to kind of have this discussion with you. I wanted to say, so we talked ahead of time, Andrea and I, about wanting to make this like as hands-on as possible, because again, it becomes sometimes an academic discussion. So we want to make it hands-on. If you do have an ability maybe to have a second screen or to have your own software up as we go through some of these strategies, I think that might be really helpful. So you can see kind of the inputs and outputs in your own software. And then Andrea is actually going to share her screen in a little minute here and show you like specifically in the software some of the strategies. So if you have time to kind of and the ability to pop up your software on another screen or in a way that works for you during the session, I do think that would be helpful. We also built out just kind of like a scenario. So we're going to take a self-employed trucker filing on Schedule C. So new truck purchased for $80,000. So that we have a second asset. We have a trailer purchase, $2,400. And then we have a Cadillac Escalade purchase, which the client says that he only drives from his house to the lot where he stores his truck. And he specifically says, I have another car that I use for any personal miles that I drive. So those are the three assets that we're going to kind of look at and work through this example. And with that being said, Andrea, whenever you're ready, I can kind of like, if you want, I can read off like some of these strategies and you look in your software, or if you have this list on your side, do you want to lead it? How do you see it going best?
I have the list open on another screen. So if y'all see me looking over to the side, that's what I'm looking at. So we can just kind of work through the order that you have it here, Andy, because I think it flowed really well. And we
Awesome.
can start with chatting about that de minimis safe harbor if you think that's a good place to start. Let me get my software pulled up real quick. We're gonna look at, what we didn't say in this scenario is what type of entity this business is. So we're gonna start out looking at this scenario as if he's just a single member LLC or a sole proprietorship, right? So we're gonna be looking at the taxpayer's actual tax return rather than an entity return.
Yeah.
Let me pull it up. I got to pull it up when I'm not sharing my screen because I got to make sure I don't accidentally show any of my actual client information.
Yeah, that's always important. Yeah, and I think for purposes of this discussion, just because Schedule Cs are so plentiful, and so many of the members have like a lot of clients that will have this exact scenario, I think if we confine it to the Schedule C would be probably good for this call.
Sure. There will be a couple of points when we get to talking about Section 179. I am going to touch on entities because S Corps and partnerships, Section 179 works very differently than it does bonus depreciation. And so we're going to touch on that just briefly. We won't get too into the weeds because we've got a lot going on here. So let me share my screen. All right. So you guys should be seeing my Drake Tax screen. Those of you who are Drake Tax users, this probably looks super familiar to you. I don't have a lot of data put into these returns. Right now with this taxpayer, I have nothing. So we're going to start out by just going to the asset screen. And again, I know not everyone here uses Drake, so your process to navigate might be a little bit different. The way that you enter assets might be a little bit different. But in this case, we're going to take I'm going to say he's in Virginia because that's where I am, but you can make it wherever. We're going to say that his Schedule C business, and I'm going to just shortcut this and just put truck. And we're going to say $70,000 in gross receipts for 2023. That just kind of sets the stage. I'm not going to worry about recording expenses. We're just going to roll with that 70K. So the first thing that we're going to look at is the truck that he purchased. In Drake, assets get entered into the 4562 screen. I like to see the item detail screen because I want to see all of the options and then I can manipulate things that I need to. So we're just going to call this his truck. I'm going to learn how to spell. We're going to say he bought it on January 1st because I like simple round numbers. And Andy's scenario said that he paid $80,000, right? That's pretty simple so far. You can put business use percentage. If this is an asset that you're going to have to track mileage, business versus personal, then you're not going to want to use the business use percentage on this screen because the percentage could change every year. In this case, we know it's a semi truck. He's only driving it for business. I'm just going to call it 100% use. It's a Section 1245 asset. In my software, that's helpful to enter. It's not going to really impact this year, but down the road, when I go to sell assets, it's helpful to know which are 1245, which are things like vehicles, and which are Section 1250, which are things like rental properties. So then now is when we get to start making some decisions, right? So we get to choose a depreciation method. There are a bunch. We all, I think, probably default to makers, right? That's the standard on a vehicle is makers depreciation. And that is a funky calculation. It's not straight line. It's different percentages over 5 years or 7 years. So you're going to make some decisions. Here's where Andy was talking about, the 150% declining balance, double declining balance, all of that stuff. We really don't have time in today's meeting because we only have an hour to go into all of the different depreciation methods. So we're just going to focus on a couple today. We're going to talk about makers, which is that 200 declining balance method, and we're going to talk about straight line. Let's say in this case, we're just taking normal makers depreciation. We'll say that this truck has a 5-year life. Again, keeping the math simple. I'm not going to elect any Section 179 for this example. I'm going to leave that at nothing, and I'm going to elect out a bonus because I want you to see what the effect is just taking normal depreciation. So, sorry, I'm having a little brain fart here. We're going to just view the depreciation schedule real quick so we can see just with no other inputs, we're just taking normal depreciation on this asset. Let me make my screen bigger so y'all can actually see it. Okay, so in this case, it didn't actually, even though I elected out a bonus, it's still taking it. So we'll fix that in just a second. Let me minimize this screen. Sorry. All right. So we have the truck. It was put in service the very first day of the year. Cost basis was $80,000. I said it was 100% business use. Remember, for 2023, bonus depreciation was capped at 80%, or the percentage was 80%. So it's taking 80% of 80,000 as bonus depreciation, leaving the remaining 16,000 to be depreciated over 5 years. Right. So this is probably a pretty basic example. If I go back to the data entry screen and I actually make it elect out of, let me make this additional depreciation election. So if I'm going to elect out of bonus depreciation for all asset classes, which is what I meant to do the first time. And this is setting the stage. This is kind of the boring example, but we're going to get to the good stuff, I promise.
Yeah. And I also just wanted to mention, so in your software, most softwares are going to auto default into claiming bonus depreciation, correct? So you should know in your software, like, how to prevent that from happening. And I know a lot of you guys already do, but can you mention for a second, like from the strategy side of it, this strategy is something like, well, I don't need as much deduction in the first year because I would rather save it. Like, this person's business is growing. I feel like their tax rate's going to be higher. Can you talk for a second about like the strategy to try to not advance depreciation?
Yeah. And so that is one of the things that we have to consider. It's easy. Like, you'll see, social media posts that say your tax accountant is missing out on $20,000 of deductions. Sometimes that's simple as electing bonus depreciation or not electing out of bonus depreciation. Some of the reasons why you might not want to accelerate depreciation: if this is the first year of the business and the business is already showing a loss, for example, or showing very minimal net income, and the business is expecting to grow or has already shown growth, right? You're doing this tax return in the following year. So you already have some revenue information for that client. If you can see based on their current year numbers that their business is growing leaps and bounds over the previous year, you may not want to accelerate any depreciation because you want to preserve as many deductions as you can for later years when they have more income to offset. In this case, assuming this truck was a good purchase and it's not going to die on him in year 2, he's probably not going to have to buy another truck for quite some time. So you can't say, oh, well, he'll just buy another asset in year 2 so he can take more bonus depreciation next year when he has more income. He might not be in a position to either need or want to buy another asset. So these are conversations that, in my opinion, you should be having with your clients. You should be talking to them about what do they expect to have happen in their business next year? What about the year after that? Another reason you might not want to accelerate depreciation is if they think they might be selling that asset in the next year or 2, you're going to have that much more depreciation recapture. And so if he bought this truck and he's like, this is just to get me started, I already know 2 years from now, I'm going to buy a new Freightliner. You may not want to accelerate this depreciation because 2 years from now, he's going to have a big old chunk of income to claim. Remember, we can no longer like-kind exchange assets like vehicles. 1031s are only allowed for real estate. Back in the day, you used to be able to just like-kind exchange a truck into another truck and defer those gains, but you can't do that now. So it has changed the planning conversation a little bit. So those are usually the 2 main reasons that I don't take accelerated depreciation for clients. Either we know their income is going up and they're going to need more deductions next year, or we know they're going to be disposing of that asset in less time than it will take to depreciate it in full anyway, and we don't want to have a bunch of depreciation recapture. Does that make sense? Cool.
Yeah, it does. And also with Schedule C clients, right? Like there may be a spouse involved that, maybe they just quit their job, their W-2 job making $300,000 a year. They really need. So just like being able to measure when is the highest tax rate going to be applied to this income most likely, and be strategic about it. And then also be able to actually communicate some of what you said to the client so they know, hey, this is why this is being done. And I feel confident that my tax pro has my knows how to actually save me money.
And that you bring up a great point, Andy. One reason that you may want to consider taking accelerated depreciation when you may not have otherwise is if there is some unusual circumstance in their 2023 tax year that has resulted in much higher than normal income. So like Andy just said, maybe they got a crazy huge bonus at work in a W-2 position, or they got, I don't know, crazy lottery winnings, or for some reason they had an unusual one-time circumstance that's resulting in much higher income that year. You may want to accelerate depreciation to help offset that one-time event. They're going to have way less income next year, so they're not going to need as much depreciation deduction next year. So there are reasons to defer or skip taking accelerated depreciation. And then there are some reasons that may not even be related to the business itself that you would want to accelerate depreciation. So yeah, you got to look at all those factors. When we're talking about accelerated depreciation, we're talking specifically about Section 179 and bonus depreciation. So if you haven't had much opportunity to, talk to other accounting people, other tax people, if you were unfamiliar with what that jargon meant, that's what we're talking about. Accelerated depreciation generally means Section 179 or bonus. So then how do you decide which one of those to take? How many of you have found yourselves in a tax return where you have to make that decision? Should I take Section 179 or should I take bonus? If you have Schedule C clients, you've probably all been there. And so I'd be curious to hear, how have you made that decision? If anyone wants to really quickly give a brief synopsis. You don't have to if you don't want to be put on the spot. That's okay. I can talk you through it. I think by now y'all know I can talk.
I think that I have chosen 179 because it's more flexible. I can just choose the amount I want according to the needs of the tax return this year, where a bonus is 80% on all asset classes, so it's more stringent.
Yes. So that's a great point. Section 179 is super flexible. Unlike bonus depreciation, so we'll start with bonus. Bonus depreciation for 2023 was 80%. If you do not elect out of bonus depreciation, you're going to end up having to take 80% on every asset in that class. And by class, I mean, is it a 3-year asset, a 5-year asset, a 7-year asset, and so on. If you do not elect out of bonus, you have to take 80% for every asset in the tax return in that asset class. Very inflexible. On the flip side, Section 179, you can really fine tune that client's net income position because you can take as much Section 179 as you want. let's say in the example of this truck, I don't want to take 80% bonus because that's crazy. He only made $70,000. We don't need to generate this crazy, huge loss. But let's say I want to take more than just the $16,000 that we would take under makers. So maybe I'm going to elect $20,000 of Section 179 this year. I can do that because it's that flexible. And I can elect to take it, and I didn't even type the same amount in both places. I can elect to take it on this truck, but not on the next truck, right? Like say they put 2 assets in service that are the same asset class this year. I can choose how much Section 179 I want to take, and I can choose on which assets I want to take that 179. I can spread it out. I can restrict it all to one. So it's super flexible, unlike bonus depreciation. So that'll be something to keep in mind. Like maybe you want more than the base amount of depreciation, but you don't need to go all the way to 80%. Section 179 is how you'll get there. Bonus depreciation, you have no choice. You're either in or you're out. And again, if you're in for 80% for every asset in that class. So it can be pretty inflexible.
Thank you for joining us. I'm Imelda. Join us next week as we continue to share mini audio clips of the Schedule C tax prep process. If you are interested in listening to the full process and want to be part of the Dream Team community, please visit prontotaxschool.com or email us to support@prontotaxschool.com. Being part of the Dream Team membership comes with getting expert support, top-rated training programs, and weekly video live events. We look forward to having you on board.